Well, there has been a growing divergence, we know, between Canada's stock market and the U.S. market. Our next guest is focusing on the divergence in the economies as well between Canada's economy and the U.S. economy, and warns that if we continue on this track, we could be in for increased pressure, particularly on the Canadian dollar. Let's bring in Jean-Francois Tardif, founder and portfolio manager at Timelo Investment Management. Thanks for joining me.
Thank you for having me.
And in the flesh, so exciting.
Yeah.
Now, normally I come to you, we talk about junior mining, we talk about junior energy stocks. It's rare that I get kind of this macro thought from you, but you are spending a lot of time thinking about the economy and how it could, filter into equity. What are your thoughts?
Yeah, I mean, we see a very, very important divergence between the Canadian economy and the U.S. economy. For example, the GDP per capita, we don't have the final number for the first quarter where we think it's going to be negative. So 6 quarters in a row where the Canadian GDP per capita is down. And CapEx, capital investment outside of houses, is also down per capita for the last few years. That's not good, because if we want to be all richer, we need to grow the pie, but not just grow the pie, but grow the pie per capita as well. That
often, sits at the feet of this concept of productivity. And that's a difficult thing to kind of wrap your head around. It's a difficult thing to campaign on. But is that kind of the source of what's going on here?
Well, definitely is one. I mean, I guess you're aware that productivity in Canada has been very weak, around 0 lately. And that's not how you grow the pie. I mean, I have some views of why. Taxes. If we compete against the U.S., in North America, we compete also against Mexico. So if you're a big company and you're thinking, where am I going to build the next plant? Canada, U.S., Mexico. Mexico has cheap labor. U.S. has the market. We're a little bit away from the U.S. So, and then if tax is high, you mean you have to pay the management, the team, more to compensate for the tax that people have to pay.
We're giving out billions for battery plants.
Yes, I don't think it's. I think we could have got a bigger bang for our buck. Like the U.S. are giving billions of dollars for semiconductor plants, and that's going to have a much bigger bang for their buck, I believe, than what we're doing here with the batteries.
Does this affect, your relative attraction? So for so long, the TSX is kind of unanchored from what's going on in the Canadian economy because we're so levered towards commodities. But do you think that is affecting the way you think about deploying capital?
Yeah. I mean, if we keep going where we're going, I have the view that Canadian dollar is going to go down substantially. And I'm a person that was here in the studio years ago. I'm talking like 15, 20 years ago, when the Canadian dollar was at 67 cents, and I predicted that Canadian dollar was going above par, up, and it did. But now I'm predicting the opposite, because to
what level?
I think it could easily go to 50 cents.
50 cents?
Yeah, which is, it's, I mean, other currencies in the world have those type of moves all the time. So, but it's not going to happen overnight.
What gets us down to 50 cents?
Well, okay, so we have here in Canada a housing affordability, right? Mm-hmm. And we have wage pressure because people can afford houses. The price of everything is up, like insurance is up 20% and so on. So people are going to ask for higher wages, which creates higher inflation, which means higher inflation means the economy is not doing as well. And then you have in Canada, we have 30-year rates at 3.5%. Well, I think it could go to 4.5%. So that just hurts a lot of people, and that means the economy is weak. That means investors, if they see a weaker economy, which is already happening right now, it means investors will be less interested in investing here. So we're foreign money when they come here, and let's say they want to buy our banks, they want to buy our companies, or even private investments, they need to buy Canadian dollar. And if they say, I'm not interested, I think it's more interesting in Mexico, or it's more interesting to invest in Arizona or some other places in the U.S. That just means the Canadian dollar is going to go down. So it's not going to happen overnight, but it's a slow erosion that could happen if we don't change this trend. That's what's going to happen. I believe the Canadian dollar will just keep eroding.
So tackling what? We got to tackle affordability. We have to tackle, where we're generating employment. What else?
Taxes. I would say taxes are also very important. Like the top bracket in Ontario is roughly 54. In the U.S. is 39. So major.
How are we going to balance our books if we're cutting taxes?
Well, I don't know.
That's the hard part about it, right? Especially in the U.S., where they are spending, they've also got a big fiscal situation that is hardly sustainable.
Yes, I agree with that. 6.5% deficit is too high, not sustainable. There's many ways. I mean, I don't want to necessarily. I don't have the solution. There are some solutions. I mean, we know, for example, in Canada, Frank Stronach and I think Mr. Rosenberg has spoken about this, where the percentage of our GDP has been going to government spending and also government employees. So the number of government employees has increased a lot more than our economy the last many years. And you can do that for a while, but you just can't keep adding and adding. So because the economy just becomes a little less efficient, and that means less productivity, and productivity is how you get richer. That's how you grow a pie for an economy. You need to have higher productivity.
And I guess that does take investing in tech, which certainly is going on in a major way south of the border. The other side of that, maybe not always matching up on the growth side, is being a little bit more risk averse and thus more stable, right? We tend to not have the major economic blow-ups that happen south of the border because the risk taking is generally lower. So that's the kind of Canadian advantage.
Yeah, I mean, there's definitely advantage. There's definitely an advantage of being in Canada. I mean, I was born here. I love my country, but I mean, entrepreneurship is important. If you want to grow an economy, you have to have some risk, and encouraging entrepreneurship should be probably part of the solution.
And do you feel like, among your peers, among the other money managers that you speak with and the investor base, that this is maybe moving higher up on the priority list of things that they're talking about when they're talking about investing in Canada relative to outside?
Yeah, talking to a lot of other people, I would say, well, I'll give you an example. Okay, I'm not going to name the person, but I have dinner with a CEO of a Canadian public company that has assets all over the place, including the U.S. I'm in the U.S., having dinner in the U.S. And well, that person says, I definitely didn't want to work from the Canadian office because I don't want to pay these crazy taxes. And so, I mean, this guy's still working for the company, but that's an issue there, right? So the brain drain, I guess, is a term. Like if the country is attractive on many metrics, including tax, but there's other metrics, well, you attract people. If it's the opposite, then people leave. Good people leave, and maybe they go in the U.S., or Americans don't come to Canada, and maybe they would have otherwise.